All right, today we're going to dive into something pretty cool. It's a single academic paper from 1992 that, and I'm not exaggerating, completely flipped the world of finance upside down. It took on this idea that was basically considered law and gave all of us a brand new way to think about investing. And it all kicks off with one simple but really powerful question. For decades, the main idea connecting risk and reward in investing seemed, well, perfectly simple. But what if that core principle, the one they teach in every business school and use all over Wall Street, what if it was just flat out wrong? That's the huge, explosive question we're tackling today. Okay, so to really get what changed, we've got to go back and look at the old rulebook first. For pretty much the entire 20th century, modern finance, the whole shebang, was built on top of one single foundational idea. And that big idea is something called beta. Now, the easiest way to think about beta is as a measure of a stock's sensitivity to the market's overall mood. So a high beta stock, that's like a speedboat. It just zips up when the market is flying high, but man, it can crash down hard in a storm. And a low beta stock, that's more like a giant ocean liner. It's slower, steadier, and the waves don't toss it around nearly as much. So this whole idea was officially wrapped up in something called the Capital Asset Pricing Model, or you'll hear it called CAPM. And its promise was just so simple, so elegant. If you want a higher return from your investments, you have to take on more risk, and that risk was measured by beta. You buy the speedboat, you get the chance to go faster. It made sense, it was elegant, and for a very long time, it was treated like gospel. But here's the thing. In science, and definitely in finance, even the most beautiful, elegant theories eventually have to face the cold, hard facts. And back in the late 1980s, the evidence against beta really started to pile up.
And this is where our two main characters enter the story. In 1992, these two researchers, Eugene Fama and Kenneth French, they just dropped an absolute bombshell with their paper, The Cross-Section of Expected Stock Returns. They weren't just poking holes in the theory, they were putting it on trial, and they brought decades of data as their evidence.
And buried deep inside that paper was this one sentence, and this was really the shot heard around the financial world. They said, quote, "The relation between market beta and average return is flat." Now, in plain English, what they were saying was, beta's a dud. It doesn't work. That core promise of the big theory, it just wasn't holding up in the real world.
And this is exactly what they meant when they said flat. When they actually sorted all the stocks by their beta and then looked at the real returns people got over almost 30 years, they found pretty much no difference. Those high-risk speedboats, they weren't actually outperforming the slow and steady ocean liners. The theory was officially broken.
So that's a huge problem, right? If the main way we measure risk doesn't actually predict returns, the entire model just falls apart. And that led Fama and French to ask the obvious next question. If it's not beta, then what is it? And by digging through all that same data, they didn't just tear down an old theory. They actually built a new one. They found two other characteristics that did a much, much better job of explaining why some stocks do better than others.
And here they are, the two hidden forces. First up, company size. What they found was that, on average, smaller companies actually delivered higher returns than the big blue-chip companies. And second, company value. Now, this one's a little trickier. It compares a company's book value, what its assets are worth on paper, to its stock price. And what they saw was that stocks that were cheap compared to their book value, let's call them value stocks, consistently beat the more expensive so-called glamour stocks. So now they've got a brand new hypothesis, right? Maybe it's not all about market volatility. Maybe it's about being small and being a bargain. The next logical step, of course, was to see just how powerful these two new factors really were when you put them to the test. And this table, this right here, is the smoking gun. It's a simplified version from their actual paper. So along the side, you've got company size, from small down to large. And across the top, you've got value, from low-value growth stocks all the way to high-value bargain stocks. Now just look at the corners. The large growth stocks, they returned about 0.89% a month. But then, look at that top right corner, the portfolio of small, high-value stocks.
Yeah, 1.92% per month. That is a massive, massive difference. We're talking more than double the return of the large growth stocks. This wasn't some tiny statistical blip. It was a huge, consistent pattern sitting right there in the data. The combo of being a small company and a value stock was just incredibly powerful.
The conclusion was just undeniable. When you looked at a stock's size and its value, you could explain the differences in returns across the entire market with, frankly, stunning accuracy. beta, the old champ, it was completely left in the dust.
So, you might be thinking, okay, that's a cool history lesson, but why does some academic paper from decades ago matter to me today? Well, because its discoveries didn't just stay in the library. Oh no, they completely reshaped the entire investment industry.
This research literally gave birth to what we now call factor investing. This whole idea of building portfolios that specifically target these characteristics, or factors, like size and value. It's why we have this explosion of smart beta ETFs and funds that you can go out and buy today. It gave analysts a brand new, way more sophisticated toolkit. And today, trillions, with a T, trillions of dollars are managed using the principles that Fama and French laid out right here.
So if you take away just one thing, it's this. Fama and French taught the world that risk isn't just one simple thing. It's not just about how much a stock bounces around. True risk is multidimensional. There are different kinds of risk. The risk that comes with being a small company, the risk of being a distressed value company. And it turns out, investors get paid for taking on those very specific risks.
And really, their work just blew the doors open for a whole new generation of research. Since their paper, other factors like momentum and quality have also been identified. Which leaves us with a final and pretty fascinating question. What are we still missing? What other hidden forces might be quietly driving returns in the market, just waiting for the next great theory to bring them into the light?